And we are live. Let me know if you guys can hear me. It's been a while since I did a live stream, but happy Fed Day. Some big news today that was announced from the Fed. They actually just decreased rates by 50 basis points. So we're going to be talking about that in today's video, the impact regarding mortgage rates, and of course, the housing market as well. I'm going to be joined by Jim Black here very, very soon. He is actually in Las Vegas right now, so he's rushing to his hotel to hop on. But yeah, everyone, thank you for joining us. Steve, good to see you. Thank you for joining us today, as always. And it looks like Jim Black is here. Jim.
Hello. How you guys
You
doing?
made it, man.
Yeah. Good to see you. Can you guys see me okay?
I can hear and see you just fine.
Awesome. Thank you so much. I'm in Vegas right now and at a technology conference for real estate and lending and all the tech innovations coming. So thank you for having me on today. And I'm excited to share some updates and let's talk. So
yeah, absolutely. You must be out of a wind, out of breath.
Yeah, I just threw my badge off. Here it is. I just want to show you.
We just started like 1 minute ago, Jim. So we have like already 60 people joined us right now. So yeah, everyone, thank you for joining us. Kevin, good to see you. A longtime subscriber. Jeff is tuning in from an airplane. Amazing. Jeremy, happy afternoon as well. Johnny Fly, Johnny Fly. Never been a better time to buy or sell in history. Johnny always has the best comments. So funny. All right. So yeah, let's talk about what happened and where we were before, right? So before today, we're at the highest rates we've had in over 22 years. They started increasing rates back in March 2022. Big increase. How many rate increases did you say it was, Jim?
11. We had 11 from 2022 till today.
Actually. Yeah, absolutely. Yeah. And that's one of the reasons why, of course, mortgage rates increased. And of course, they had they weren't buying as many mortgage-backed securities as well. So today they announced a 50 basis point rate decrease, or a 0.5 percentage point, which was expected. The street was kind of forecasting 25 to about 50 basis point cut today. And they gave us a 50-point rate decrease, or 50 basis point rate decrease. So the Fed also provides some future expectations for what they expect to see the federal funds rate to be in the next 2 years. And that's what's called their dot plot, which is basically like asking the Fed members, hey, where do you think that rates are going to be, or interest rates are going to be at the end of 2000, or actually this year, 2025 and 2026. So what my takeaway regarding that is that overall Fed members are now anticipating that we're going to be in a lower rate environment compared to the previous projections, which was in June. So the projections for future rates by the Fed, or the federal funds rate, is announced every quarter. So back in June, they were forecasting for higher rates, and now they're forecasting for even lower rates. So what that means for you guys is that we should see more rate cuts through 2026. In fact, the next two meetings are scheduled for November 7th and December 18th. So mark your calendars for that. I'm expecting for the Fed to cut rates by 25 basis points each of those two meetings, for a total of 50 basis points. Or of course, it could cut rates again by another 50 basis points, and then to a pause for their other meeting. But again, based on their projections right now and Street's forecasts, they're forecasting basically for another 50 basis point rate decrease through the end of the year. The committee, I'm just looking at my notes here. The committee is also projecting for a full percentage point decrease in 2025. So another 100 basis point rate decrease next year, followed by a 0.5 point in 2026. So a couple of things I want to mention regarding this, and I'll let Jim talk as well. Jim's probably catching up on his emails based on his event.
No, I'm good. I'm good. This having coffee, my 6th coffee today, so I'm good.
6th coffee. There you go. I've been feeling kind of sick past 24 hours. So all this depends on incoming data. If you guys want to mark your calendars, look at when the jobs reports are going to be announced. Of course, we have jobs reports every Thursday regarding initial jobless claims, of course, continuing jobless claims. But look at the Friday jobs report. So we should see, what, 2 or 3 more for the remainder of the year. So look at jobs report and also inflation data as well, because that will impact mortgage rates much more so than the Fed cutting rates. That's that. On top of that, this is a common misnomer. We get comments regarding the Fed just decreased rates by 50 basis points. We actually just got an email regarding this. How did that impact mortgage rates today? And so you will be probably surprised to hear that mortgage rates actually increased today, even though the Fed decreased rates by 50 basis points. And that was because it was widely expected the Fed was going to cut rates by 25 to 50 basis points. And therefore, it's not like the Fed cuts rates and they're going to see a sudden decrease in mortgage rates. The Fed controls the federal funds rate and not mortgage rates. So there's a lot to cover in today's video. But Jim, maybe you can give me some example regarding, the Fed not controlling rates. They do control the federal funds rate, which indirectly causes fluctuations in mortgage rates. But maybe you can give me some examples and some stories that we kind of talked about earlier.
Absolutely. So again, short-term, over-the-counter Fed funds rates are the amount that banks, corporations, businesses can get money from the government. So those are all short-term debt instruments. Those also directly correlate with short-term home programs or loans that consumers get. So the best example to use to explain this is a home equity line of credit. If you are at a rate of 9.5% today at 11 a.m. on your next pay cycle, next month statement, your rate should be now 9%. So there's a direct correlation at what the cost is for corporations, banks, large institutions to borrow money at. The government has set that bar lower by exactly 0.5%. So that's that part of the equation. I got over 75 text messages today, and I sent out over 100 text messages today. In a matter of 5 minutes, Jason received a few of them to explain that, again, when you look at the bond market is a openly traded buy and sell marketplace. It's supply and demand driven based upon people's expectations of the financial markets, of what the Fed says, and overall just the health of the economy. So when interest rates go down on mortgages, it means people want to lock in a return on their money because it's a flight to quality or safety. Think of a mortgage as the best backed asset you can have besides a physical precious metal in the world, right? You're getting not only a return on your money, but you're getting it cross-securitized against a physical property that probably will appreciate, if not just go flat at the word, like most markets are. So when people are concerned that they want to lock up their money, they're competing with other investors to take a little bit less return to capture that return. So the more demand there is for mortgages in their investment portfolio, the lower the return will go and the rates will go lower. There's more people wanting to have a mortgage than there are available. That way the return goes lower. The exact opposite happens when there's not enough demand or buy-side activity for all of the mortgages that are outstanding. Those mortgages have to increase their return to entice people to move from the financial stock markets to more of a fixed return in the long run. So that's how the dynamic of the bond market works. It's not only the sentiment today, but it's forecasting, forward-looking guidance and confidence in where they should place their money to make the most return. So after today's news,
mortgage-backed securities, by the way, right?
Mortgage-backed securities, yes, that's yes. Or the bond market, those things are all pretty much similar things to be aware of. So again, today, the news is already baked in about the Fed lowering the rate. I'm watching Jim Cramer live right now saying the same thing. This is old news, guys. It's already baked into the interest rates. There's not going to be a big drop on mortgage rates. We were lucky in one example last week. I have a text message here that says, pretty cool. Again, I'm not trying to be a salesperson, but this is kind of cool. The comment specifically was, Jim, I just checked the 10-year treasury before sending this, and it's higher than yesterday's close. Buy the rumor and sell the news, LOL. You locked in my rate at a very good time. Thank you, with a fist pump. So again, make your own decisions about interest rates. We talk about this all the time on this channel. What's your best long-term plan? Plan for that. Rates are going to move up and down. If you're going to be saving money by refinancing, or you're comfortable with your payment when you're buying a property, those should be the things you're more concerned about, besides timing the exact bottom or the exact top of the market.
Yeah, well said. It's interesting to see here. Can you guys see my screen? Can you see my screen, Jim?
Gotcha. Yep.
Cool. Yeah, this is what Jim's saying. The 10-year treasury note, 3.7. So actually increased by what, nearly 5 basis points today, even though the Fed cut rates by 50 basis points. So it was widely anticipated the Fed was going to cut rates. So interesting to see that the bond market actually increased, or the yield increased as of today as well.
Can you go to 1 month? Can you go to 1 month example of that, Jason, if you don't mind? Because I think that'd be helpful for people to see.
1 month, yeah, sure. This is just a
one
one.
Yeah, it's 1 day. Yep.
Go too much. This is one I don't really normally use.
Toggle on the 1D. Just toggle that arrow down. In the blue to the right, farther to the right of the rate.
Oh, sorry. Yeah.
There
I
you
usually use CNBC's, which is clean, but it showed as unchanged, which is always.
Let's go 1 month, please. 1 month.
Yes, sir. There you go.
Sorry. I just want to show you. Okay. So again, if you look at this, it's interesting. Look at September, about September 11th. September 11th-ish, 10th, 11th-ish. The rates were almost the same as they were on the 16th. So things can happen in the marketplace. Like, there was no news that came out on September 10th or 11th. But look what happened to the bond market. People wanted to lock in their return, so they took a lower return to lock in that fixed mortgage as an investor. So you're seeing these trends happen. And again, there was no news on September 9th or 10th, but that you can see that the market retreated at that point in time. So again, follow your own guidance, get your own advice. Today, if you had a line of credit, a home equity line of credit, your rate just went down by 0.5%. So if I have a $100,000 line of credit and I have a savings of 0.005, that means I'm saving today $41.67 more a day, or on my next payment, I should say, than I was the month before. That's pretty cool. So it's a start in the right direction. Again, the Fed announced that they're going to be lowering rates even more next year. That's a really good thing. That's healthy. Jerome Powell also made a comment today, something we've talked about a lot on our channel, about anchoring. He mentioned it about 12:30 today. I was watching it. He mentioned the fact that there's not going to be a lot of inventory because people are anchored in their properties. Their interest rates are so low at 2-3%. We're not going to see a big fluctuation of inventory. A lot of the reporters were asking him questions about this directly, and I welcome you to go back and watch the video. But he explained this anchoring effect we've been talking about. People that are anchored in their properties, when they do decide to move, they will be not only sellers, but they're going to be buyers again. So this inventory concern is going to be there no matter what. People are going to sell, but they're going to go move somewhere else. And they're probably not moving out of the country, so they're probably going to buy another property. So again, buying a home needs to be right for you, and you have to think long run. But this lower rates, I think, creates more pent-up consumption and demand. People now can afford to buy more. 0.5% lower in rate, if that goes lower, it's going to be a 6% buying power increase for everybody. So it's just good to be aware of these things again and make your own decisions around your goals.
Absolutely. I think that here's a really good kind of snapshot regarding what happened today. This is on cnet.com. I'm one of their expert review board members. So this is according to Catherine Watt. She puts a lot of good articles on cnet.com. It says mortgage rates moved up and down on a daily, or rates do move up and down on a daily basis in response to a range of factors, of course, inflation and labor. Today's decision by the FOMC, or the Fed committee, to cut interest rates didn't come as a surprise. Even though the economy is not on the brink of recession, the Fed opted to reduce interest rates by 0.5%, citing concerns about the labor market. But experts have told me the size of today's cut doesn't matter all that much for the mortgage market. And I actually emailed them about that today. It's what the Fed said about the economic outlook that matters more. And that's that dot plot I mentioned. Prospective homebuyers could see some additional rate relief down the road. But remember that the individual mortgage rate you qualify for is also determined by personal factors, of course, your credit score and your loan amount. A really good snapshot overall what happened today by Catherine. One thing too that I think is really, this is all kind of timely regarding this rate cut by the Fed, is that we have all-time record highs right now for credit card balances. And of course, we have elevated levels for delinquencies on those credit cards as well. So here's a look at our good Uncle Fred, and the source here is the Fed. This is the amount of consumer credit card debt nationwide. And right now we have just under $1.4 trillion of credit card debt right now. That is a new all-time record high. I mean, look at the prior to the Great Recession, not the Great Recession, prior to pre-COVID, we were around 1.1 million. Now we're at 1.3. On top of that, even though we have record high credit card balances, we also have elevated rates for delinquencies as well. 3.25%. That's the highest rates we've had going back to Q4 of 2011. So this is really going to impact people who have credit card balances, HELOC balances as well, which will likely decrease the rates that they're paying today as well. All right, let's see if anyone has any. Go ahead, Jim.
Yeah, so another thing to be aware of. So you think the Federal Reserve also only cares about the United States markets. Well, guess what? They don't. We're in a global market. Globalization's real. Exchange rates, trades, tariffs, exports, imports, our GDP is not affected just by what we do anymore in the United States. The consumers in the United States are some of the strongest consumers in the world. We drive a lot of the economic livelihoods of tens of 20s of countries, right? They count on us to buy their goods. So we also have to understand that the dollar is now weakening because of this move against other currencies. So not only does the Fed have to balance what's happening to the average American consumer, they have to look at the effects that they're going to have indirectly and directly from the change now to the dollar weakening. That means that the dollar weakening means we have less buying power to buy goods from other countries. They have a stronger position than we do as of a few hours ago. So you just have to realize that these things are all related directly and indirectly. And so when you get a better understanding of the overall economic factors in the world, in the globe, you'll see that while the Fed would like to do something, it may not be able to do that because it may have direct consequences to other things that are important to our overall economy in the world relative to just the United States.
Yeah, it'll be interesting to see other countries if they follow suit with doing more rate cuts here as well. Question from this gentleman: refinance soon? Question mark. That'd be a Jimbo question.
Refinance soon? Yeah, do it. If you've saved more than 0.5% in rate, you can do it at no cost. I think that's a good place to start. Remember, we've talked about in our previous shows, the net tangible benefit needs to be there for you, right? So you got to make sure that it's a big enough savings to make it worth your while. Just refinancing every couple months is not really a healthy thing. So make it be worthwhile. I always like to think about the break even again being about 18 months or less in the cost versus savings of doing a refinance.
Makes sense. Yes. Take the cost of doing a refinance and then decrease that by the savings. You can get your break-even point, how many months it will take you to break even. If it's over, over a year or so, then it may not make sense to refinance. And $1,000 question here: is it a good time to refi? Yeah, it depends on your goals, your rate, et cetera. So if you guys want to book a call with us, I have a link in the video description below, I believe. And also all the videos Jim and I have done as well. You can book a call with us, get a free advice regarding that. We've told multiple people actually that it wasn't a good time for them to refinance. but other people, it was a good scenario. So it just depends on your goals and your situation.
Yep.
Orlando, good to see you here, buddy. Most banks baked into a cut already. Absolutely. See if anyone else.
By the way, what this does also, this actually, if you look at the stock market, this is not advice, so I'm not giving advice. I used to be a trader on Wall Street before I was in mortgage. What you'll see is there's certain sectors of the financial markets, specifically technology companies. Now that they're borrowing money for less money, they'll be in a healthier position. So you'll notice that it's a really healthy thing for companies that are highly leveraged because they're borrowing money from short-term over-the-counter Fed funds rates or banks. Their cost of capital is going down now. That's a good thing for those companies. So maybe they aren't laying people off that they were planning to do. Maybe they can keep their prices lower or lower their prices for their consumers. These are all healthy things to get us in line. I love the fact that Jerome Powell mentioned in his comments, he's no longer worried about focusing on inflation, which is a higher interest rate environment mindset, to now he's focused purely on the labor force. That is a recessionary focus. So we have shifted away from things going out of control like they did during COVID to now trying to stabilize and make sure things run their natural course and predictable course. Things are not bad right now. Things are not out of control, but I believe the Fed's doing the right thing here by reacting and know that they have more firepower to react if they need to.
Yeah, absolutely. So Omar Cruz has a really good question. Why did rates go up? So looking here, here's the Mortgage News Daily 30-year fixed rate, 6.15%, actually increased by 4 basis points. I mean, all these different loan products increased today. And that kind of goes back to what we kind of talked about, how the rates we're seeing today have already baked into a consideration that the Fed was going to cut rates. So again, it wasn't a big surprise the Fed cut rates. And so I think my take on this, and maybe Jim has a different take, is that the bond investors, the bond market, is kind of digesting all these comments from the Fed, their dot plot, them cutting rates by 50 basis points instead of 25. They're all kind of digesting this information and kind of figuring out where we're headed. And so I think we'll see, it'll be interesting to see what the rest of the bond market does on Thursday and also on Friday. But I think right now the bond market is just kind of figuring this all out. I think the Fed clearly states here, based on the projections, that GDP is actually going to be slowing down, and also unemployment is going to be rising just a little bit. So they're forecasting, and also they also believe that the Fed or the labor market's slowing down. But I think it's kind of hard to kind of peg down why did rates actually increase today. But I think it kind of goes back to the fact that we already were anticipating a Fed cut today. Anything you want to add regarding that, Jim?
Not really. It's just we're all saying the same thing, which is great.
Yeah, right. Anyone else have any questions here? Nasir, what do you think about home prices? Will it trigger upward or downward? So the decrease in the federal funds rate doesn't really have a direct correlation to mortgage rates, as you saw today. Rates were pretty much, or mortgage rates were pretty flat today. And so I think that what's more important is that their projection for the federal funds rate is now lower than they were previously expected. Let me look at actually, I can just share my screen here with you guys too regarding this. So, okay. So here is their dot plot. This is the Fed dot plot. And let me just zoom in here for you guys. So
this is their survey, right? This is their survey. Another way of saying dot plot, right?
Yeah, thank you. It's like basically asking the members of the Fed, hey, where do you guys think GDP, unemployment, inflation, and the federal funds rate, where do you guys think it's going to be at the end of 2024, 25, and 26, and in the long run as well? I just basically ignore the long run. So they basically ask the members, hey, where do you think we're going to be at? In regards to GDP, here's that. Here's unemployment. And also the federal funds rate is the median number, which is the middle number based on their forecast by the Fed members, is going to end the year at 4.4%. Right now, because this 50 basis point rate decrease, we're at 5%. So basically, they're forecasting for another 50 basis points rate cut for the remainder of the year. We have 2 more meetings. Therefore, we could see 25 basis point rate decrease or another 50 this year in one meeting. Then next year, the end of 2025, we're going to be at 3.4%. This means we're going to get about 100 basis point rate cut by the end of 2025 compared to the end of this year. And the June's projection, this is their projection that was posted about 3 months ago. You can see how different it is, right? So we were at, what was this, 5.1 to end the year. This year, now it's decreased to 4.4. 2026 or 25, it was projected to be at 4.1. Now it's down to 3.4. So the projections in June are actually higher than their forecast right now, if that makes sense.
And by the way, there are 12 people that are on the FOMC committee. 7 of them are actual members, and 5 of them run the actual banks, the reserve banks. There's 5 members on that. So 12 people are giving their insight to that. Those 12 people are diverse across the entire country. There's people, for example, in San Francisco and in St. Louis and in Boston and New York and parts of Texas. These people are all creating the diverse approach because there are factors that are regional factors, right? Some things that may affect the West Coast might not affect the East Coast. So it's just an average example of their survey, which is a really cool way of looking at the overall perspective of the United States. So,
yeah, absolutely. I think that's it's always is there like expectations, and then their projections, expectations will change over time as well, given incoming data as well. So in regards to their question about home prices, in my opinion, this is really going to have like basically a nothing burger today regarding this rate cut. We're not going to see any big movement regarding home prices. So in my opinion, the direction in home prices is going to depend on inventory numbers and of course rates as well. But today's rate cut, basically was a nothing burger for the mortgage market.
I'm actually at a conference right now in Vegas. It's called Blueprint. It's a technology, real estate, and mortgage conference, like I mentioned earlier. I was in a roundtable discussion with, I won't name who, one of the largest portal companies in real estate. They mentioned that in a certain part of the country, private equity firms were buying 45% of all the inventory in the lower half of their state. So these real estate companies can see who's involved and who's buying. So you have not only the parents buying a property or the kids buying a property, you have a significant amount of hedge funds and private institutions buying as many properties as they can still. Because again, if it's purely supply and demand, these private equity firms can buy a property at 103% because they know it's going to take 3 years for them to build more properties in that neighborhood, or 4 years, or maybe never. So you have a lot of influence and a lot of demand, not only coming from homeowners, but from institutional investors. So you also have people in different countries. When our exchange rate changes, for example, it becomes cheaper for someone in another country to now buy here because the US dollar value has gone down. So again, some of these factors will create more demand for housing because of the fact that the US dollar is worth less today after noon than it was yesterday. So people now look at the US dollar as even more of a discount relative to their own currency in certain parts of the country. So again, and I agree, there's a comment on here from Jeff, boo to private equity firms. I agree with you. There should be regulations in place. But again, democracy, a perfect economy allows for laissez-faire, government stay out. It allows for supply and demand and equilibrium to dictate what a house value should be. So on one hand, I wish that families and private citizens could get a first shot at a property, right? Maybe there's some new regulation that comes out that it has to be owner occupied or something like that. Unfortunately, it's hard to regulate that when you as a homeowner own your property you probably want to sell for top dollar over making sure someone buys your house as a human being, right? If someone's going to offer you 103% versus 95%, you're taking 103%. So unfortunately, we have to deal with these people in today's world. Something I'm not excited about, but that's what we have to deal with. So again, just know the facts. Every market's different. Where you live is different than where I live and where Jason lives. So just know you have your own factors in your marketplace. So when we make these comments, they're generalities. They're not specific to your exact neighborhood.
Yeah, for sure. I mean, I know that for foreclosures, for example, there's that like first look period, and I think it's like 90 days for Fannie Mae, Freddie Mac.
It's normally 30, 60, or 90 days. That came around from the foreclosure days when a lot of private equity firms were getting these properties for 10 cents on the dollar. They wanted to create generational wealth for new homeowners. Unfortunately, the previous homeowners had something bad happen to them, but they wanted to try to give everyone a chance to afford a property. So that was part of the deal there before.
Yeah.
Can we talk about the Jared comment? Because I'd love to use that as an example of, I don't know.
I closed on my house on June 26th this year and got a 6.5% rate. I am looking forward to being in the 5s or buying down to the 4s.
So great. This is it. I'll just give a little quick scenario here. So today's rates, if you have an average FICO score of above 700 and you're owning a single family residence and you're in a conforming loan limit size, you are now in the 5% range. Again, get a valid quote. We're not quoting rates on this call, but in this example, there's at least, Jared, at least a 0.5% difference in rate for you at probably no cost or low cost to think about and consider. Again, you want to do it at your time, what's right for you, but this is a great example. You could probably save money already, if not at no cost, at very little cost. So great scenario. This is most of America in the last 2 years have bought homes. So again, great example. Can you go back up 2 comments to Luis's comment?
Yeah, and we actually just quoted someone at, I think, around 6% for refi as well.
Yeah, no cost. Yep.
Yeah, and Jim, I'm only licensed in California, by the way. Jim is licensed in California, Texas, and Oregon, but more states to come very, very soon.
And there's some exciting news coming for sure. So go 2 minutes, right one below that would be great.
So this is Louis. Yeah, absolutely. Thank you for your support, Louis. I got a 7.45% rate and looking forward to, wow. I mean, that's an opportunity.
You're probably about 1.5% lower right now.
Yeah.
That's huge. So if you had a $300,000 loan, for example, that's a savings difference. I take $300,000 times 1.5% and divide by 12. That's a simple interest difference. So $300,000 times 1.5%, that's $4,500 a year in savings of interest, just interest expense. That's pretty significant if you had a $300,000 loan. So if it's even higher, it's even bigger. So Louis, do something soon.
Do something soon, absolutely. I mean, that's a good opportunity right there to save some money. Let's see. Try to see if there's any comment. I saw this one. How will the collapsing Federal impact the carry trade and the? I'm not sure if I understand the question.
So a lot of countries are trying to get off the dollar. They don't want to be backed by the dollar anymore. Saudi Arabia, China, they've always been threatening to get rid of the U.S. dollar as the denomination of currency trade. What you'll see is basically every time the U.S. dollar goes down relative to other currencies, the buying power of those other countries on our goods and services is stronger. So in some sections of our economy, it might be better for certain things for us. Maybe we have more labor that's hired because it's cheaper now today than it was yesterday on the dollar. Properties in the United States are now cheaper than they were yesterday because the dollar exchange rate is weaker compared to those countries. So it's just going to be aware.
Lewis has a follow-up. Bought in December with essentially no competition for 525, appraised at 570. That's huge. I haven't seen a big difference in that. So you already have built-in equity there. That's huge.
And look at that. You have 465 outstanding, Lewis. Like 465 times 1.5%, that's a difference of $6,975 a year in savings of pure interest. Or on a monthly basis, $581.25. You could put that into paying your loan down faster. You could put that into paying off credit card debts. You could put it into a 401k or a college savings plan, or go out to dinner a few more times a month. That's really cool. And that's a really awesome story. I love seeing things like this. You made a decision for yourself, not assuming that rates were going to go lower, but they did. And now you have a direct benefit that you weren't expecting. This is awesome. This is a great example of when everyone's doing one thing, do the opposite. Be a contrarian. Do what's right for you. Don't follow the herd or the pack. Like, do your own thing. So I'm really excited for you, Lewis. Congratulations. That's really cool. And if you think about the rate now compared to when you bought the house, it would also mean that the house should have sold for much higher because the buying power is so much higher now. So again, if you're saving
since December as well.
Yeah, so 1.5% difference in rate going lower is about 17% more in buying power. So congratulations. Great story. Thank you for sharing it.
Yeah, congrats. Jared has a follow-up on this one. So he bought in June for 6.5%. And he says here, I went with a lender that charges a broker's comp, so the rate is lower. So maybe, Jim, you can provide, what is the difference between a refi versus no cost versus cost?
Yeah, we've talked about this before. So we are mortgage brokers. There is banking and brokerage. There is retail and wholesale. We are wholesale at our company. That means we let other lenders compete for our business. We also control our own margin, same margin for all of our products, but we can operate at a lower margin than a bank who has brick and mortar on every street, who runs ads on national TV shows, who has a lot of overhead and staff. So mortgage brokers are winning. Mortgage brokers are a better way to go today. Hasn't always been the case in my career, but it is a better way to go because it's really about connecting with the local professionals that you work with in your marketplace. They control their margin. Again, we have a lower margin by about 65% compared to a bank that's in our marketplace. Everyone's different, so realize everyone runs their business differently. Jason and I just want to help as many people as we can, so we're lower by that reason. But again, each day rates change, and your scenario is unique and different. So,
absolutely. And Lewis says, it's legit because of this channel. I learned a lot about before buying. So big shout out to you guys. It's so awesome. I mean, it's just a cool thing about, I created this channel like back in October 2019 about like living in Sacramento, and never thought we'd have a community here of like 100,000 subscribers. And it's really cool to share insights, what I'm seeing in the market, and bringing on Jim onto these live streams and also videos about the finance side of the market as well. It's just been, I don't know, it's unbelievable. I just can't, I really appreciate you guys' support, really do.
Yeah, Jason, awesome job, man. Again, I'm really proud of you, dude. We talked about this before. I think I was follower number 2 or 3 behind your mom and your wife.
My mom and my wife beat you. Yeah.
Maybe I beat one of them. I think I was number 2. I don't know if I can go like look
I think I had to tell my mom how to hit the subscribe button. My mom's like 80, almost.
No, she's not.
My dad just turned 80. So Jared says again, I bought a new build for $652 and it appraised for $689. That's awesome. 2 years ago, the builder wouldn't even let you look at a contract without $65,000 down. But winter of 2023-24 was slow, so got in for 10% down. Yeah, I mean, I remember, as you guys know, I'm an agent in the Sacramento area. In 2020 through early 22, you were like lucky to get on the waiting list. You got on the waiting list, and if the buyers before you backed out, or if they didn't want to buy the house, they'd contact you. And it was like, congratulations, you're getting a phone call from me. You have the opportunity to buy a house. And now it's much different. I'm getting emails from builders saying, hey, we're offering all these incentives. There's a surplus of houses for sale. They're brand new nationwide. And so you can get a lot of incentives. You got rate buy down, free builder upgrades, free closing cost credit, et cetera. So yeah, the market has changed drastically compared to the craziness of the past several years. Truth teller, price reduction matters, not rate cut at Jason Walter. I know that a lot of people are waiting for home prices to decrease, but when we actually look at the stats, though, I mean, it's like remarkable how few the number of years in which prices decrease compared to the previous calendar year. I'd make a video about this. I think it was like only 4 calendar years compared to the previous calendar year in which home prices, based on the median sold price, according to NAR, went down compared to the previous year in the past 34 years. So 4 of the past 34 years, prices went down, but 30 of the past 34 years, prices went up. So I know a lot of people don't want to hear that because you want to see home prices decrease, and eventually home prices will decrease, but buy what's right for you. I understand if it's challenging to buy a house because of property taxes, elevated rates, of course, near record high home prices. I understand that housing affordability is a huge, huge issue. In my opinion, we really need to get our government to start enticing home builders to build more affordable, smaller houses, and not these like $1 million properties that don't really benefit the everyday average home buyer across the United States.
Agreed.
My wife is calling me right now. She probably doesn't know we're on the live stream. Let me tell her.
Okay, I'll give some more feedback too. There's a comment about next comment. Let's see here. Well, I'll bring up something. So if you're a homeowner and you have an interest rate of 2.5%, and you've lived in your house for now 5 years, and your house has gone up in value, and you can get a renter in there to cover your mortgage and make a little money, are you going to sell it when you buy your next house, or are you going to keep it? That's going to be another thing that is going to be happening to a lot of families. They're going to have to decide if they're going to keep it as an investment or if they're going to sell and use the capital to buy their next house. I got a feeling a lot of people are going to keep their homes more than they're going to sell them because their rate is so low that you're almost making arbitrage just on that factor alone. Even if you do not make money as a rental property and just break even, that cost of carrying your interest is so low relative to today's money. You may see that a lot of people not only have an anchoring effect, but they have an investment anchoring effect where they're going to keep their property and maybe buy something else, but keep their current home. Because that's truly a way that they can maybe make more money.
Yeah, absolutely. It definitely could happen. And if you have a rate below 3%, you're looking at your payment versus what you could earn for your rents. They might decide to keep their house and rent it out. Rose, right? Cute dog. 100% price reduction. People need to start offering 25% less, especially in Florida. The taxes and insurance. Yeah, I mean the taxes and insurance, and of course, if you're in a condo, in Florida,
special assessments, all that stuff, not good.
Yeah, absolutely true. Johnny Fly, he's based in the Sacramento area. Sac County active inventory is up 36% year over year. Meanwhile, the median sale price is up by 1%. Make it make sense. I would say that inventory is a leading indication of our housing market, and anything that has to do with a closed home sale is a lagging indicator, right? So inventory is up by 36%, but still down from 2019 though as well. So time will tell what will happen with prices.
As rates go lower, homeowners will feel like they can get a similar interest rate to move potentially. So you should see more inventory come up as rates go lower. But it also means the demand for those houses will go higher. So again, inventory might go up, but it probably will mean the median sales price will go higher too.
Yeah. AJ, hopefully they cut the red tape for home builders and provide tax breaks, et cetera, for them in order to increase inventory. Yeah, I think in Sacramento area, I read somewhere that just to break ground, like, the permitting process, et cetera, it's like $100,000 per home. And if that was cut down in half, for example, we could see some builders offering, smaller houses, building smaller houses that are more affordable that people could buy. It's a huge problem. If you look at the housing starts graph, it's basically a tanked after the Great Recession and remained at very low levels, even though it has been increasing the past several years. But the run up right now is far less than the early 2000s and 1990s as well, because of, and this is kind of an interesting thought as well, is that today's brand new houses are tomorrow's existing houses, right? So if we see a lack of new supply in the market, a lack of home building, that really impacts the amount of existing houses for sale down the road.
And think about the house quality too. Most houses were built in the 50s and 60s throughout the country, right? Because there's a big run up of population growth then. So those houses are dated. Those houses are almost 70 to 75 years old. They need updating. So if we don't have more inventory, we'll have to renovate more properties. It'll be more expensive. It will not be a good thing. I'd also like to mention too, this builder issue is not only at a federal level, it actually starts at the local level. And I'm not a politician. I'm not in politics. I can't stand it. But what I would say is when someone wants to build a new community, these local jurisdictions or governments don't have millions and millions of dollars to go build a new school or open a new fire station or a police department. So they have to have collaboration with the local builders to do that. A lot of them pass on the cost directly to the builder. Hey, you want to build a new subdivision that's 5 miles away? Great. You're paying for the 5 miles of pipe to pipe sewer pipes and water pipes and electricity to those properties. We're not going to do it. That's what they think of when they think that way.
Doesn't that just get passed on to homeowners in the form of Melrose, though?
It can. It cannot. Every single county has different laws around property taxes, assessments, and also Melrose. Melrose is not everywhere throughout the country. It's just in certain areas. And Melrose does not mean you're ever going to see the benefit of paying that. There was a area where we live, Jason, in the East Bay, in a town called Brentwood, California, which is in the East Bay, right near Sacramento or near the Valley. They're paying $250 a month for Melrose for a BART station, which is the Bay Area BART transit station, to go out to their location. Guess what? It never got there. So these properties have been paying $250 a month for tens of 20s of years for no benefit. So it's a slippery slope. And what you'll find is that builders that have deep pockets, bigger builders, will be kind of put in harm's way to cough up money to do this stuff. So a builder doesn't get excited about that. And they're going to pass it on as a higher price point. They're going to pass it on to the consumer again. So builders are normally publicly or privately owned companies. They are not nonprofits. They aren't subsidized by the government. They are in business to make a profit. So unfortunately, we're not aligned a lot of times with their goals at the federal government, that we should have more subsidy and more support in that stuff.
Yeah, I wish they provide some incentive for builders to build smaller houses, because building $1 million houses doesn't really help the everyday Americans. By the way, guys, if you guys have any questions, we're going to be wrapping this live stream up at 4 p.m. because Jim and I have a call with a YouTube subscriber as well. So we're wrapping it up in about 10 minutes here. As a driver in Florida, I see recently built homes abandoned or showing signs of financial stress still in the same neighborhood. They are building more new houses. That's odd. Your view. I have not heard about that. Jim, you have any comments on that?
I do. I would say it may come down to the health. It may come down to the health of the builder. Maybe they got hurt on another project. Maybe they have another investment that they've made that they're focused in on. Also, sometimes when a builder buys land, they have to buy it right, which means if they overpay for land, they're going to have a hard time making money because they're already against the wall as construction costs go higher, as labor costs goes higher, as all these BS fees they got to pay for the county, state, and city stuff happen. So if the land is not bought at the right price point, that's where things can go wrong. So maybe in this example, maybe they didn't buy the land correctly, or maybe they have hardship from other investments that they made. I don't know. But yeah, it is odd. If it's the same builder, that's really odd. I would bet it's a different builder. It's building in the same market.
That's what I was going to say. You probably are. I mean, like my area, you have like a giant area and there's like multiple builders there. You can cross the street, it'll be a different builder. So you might see one builder that maybe is seeing this financial stress where maybe another one's not potentially. Johnny Fly mentions here that in California, you need to have a fire suppression system and solar, which increases building costs as well. Yep. Yeah, it's actually required to have solar on new houses, whether it's a lease or not.
Welcome to California.
Welcome to California, yeah. The builder is now charging CDD fees to homeowners of new homes in Miami-Dade County. I don't know what CDD fees are. Do you know what that is, Jim?
I would imagine it probably is certificate of occupancy of some kind. They may be called something different, but normally
Oh,
there
yeah,
are fees till the very end of building.
there
So
you go.
you get a final
Yeah,
permit signed off. There's probably a final occupancy fee of some kind that's getting passed to the consumer, even though the builder is the one that owns it till it's sold. So crazy.
yeah. And Rose, you're very welcome. I mean, Florida is definitely different in California. We all have our challenges, of course. When will California become affordable? Lots of layoffs, still Zillow, Redfin, keep hoping.
Keep open, yeah. I would say it'll be affordable in 1784. So we'll go back a couple hundred years and
Gee, yeah.
make it affordable.
It
I
is
would
crazy. I think that, like, our median sold price is around $900,000. I mean, it's just absolutely wild. You need like $200,000 in income to afford a
And
average
by the
home.
way, the conforming loan limits were announced, and you'll hear about it on every single spammy social media post from loan officers. But there'll be higher loan limits again this year, coming into 2025, because again they look at the first 3 quarters of the average house prices in your specific county. They make adjustments specifically to the county average median price. So unfortunately, that's gone up in most areas. It means a higher loan price. It means even crazier numbers for everybody.
So CDD, thank you, Rose. RB community development fees, basically. Cool. Thank you. Cam, do you think if rates continue to go down, prices will go up? So this is my opinion. Maybe Jim, you might share a similar one. In my opinion, when rates decrease, you're going to see more buyers entering the market than home sellers. Every home buyer right now wants to see rates decrease and or prices to fall because, of course, it makes more affordable to buy a house. But not every homeowner is going to be a home. Not every homeowner wants to be a home seller, though. If that makes sense. What do you think
I
about
agree
that,
with you,
Cam?
but supply, it's just, in my opinion, I'm simple on this one, supply and demand. The less something costs to buy, the more demand will be for that item. Therefore, it'll probably be higher priced.
Yeah, I would say, yeah, it's local, of course, as well, right? Areas that have more houses for sale right now compared to 2019. There's a lot of parts in Florida and Texas, for example. They have a lot more houses for sale compared to the Northeast part of the United States. There's a lack of houses for sale. So it's really regional, of course. Real estate is local. We need to hop off this live stream unless anyone else has some last minute comments, questions. Jim Black and I would love to answer your questions. Let's see. What's all the cute dogs? We got all these like cute dogs. That's a good one. VS, will there be an increase in supply in now? Maybe you're referring to because of rates decreasing. I'm not too sure. I'm not sure about the question. Sorry. I don't think there'll be an increase based on rates falling if they were to fall. Johnny Fly, my house in Lincoln that I bought in 2000. I mean, like, what a great time to buy a house. 2010 for $160,000, just sold for $483,000. Wild. That's cool. Cam, thanks for all you do, Jason. My pleasure, Cam. Thanks for your support here in Utah and always tuning in to you. I feel starstruck that you called me a name. No way.
So
Not
Cam,
at all. I mean,
Cam, we're going to be doing loans in Utah really soon. I just did 6 hours of continuing education for that state. So Utah is definitely a very compliant place to be, and hopefully we'll be there soon. So
absolutely, along with many other states, by the way. But yeah, Cam, thank you for all your support of the channel. I'm just a dude on YouTube. So, all right, last minute questions. 2009, I saw what's happening now. Lots of for sale signs. Yeah, I mean, like, if you guys want to learn about like what the market was like prior to the Great Recession and compared to now, take a look at my previous video. I posted it this morning. I did a collaboration with Michael Zubler of One Rental at a Time. He gave a fantastic example about what the housing market and what it was like to buy a house, get a loan in 2006 compared to what's like right now. So I would urge you guys to watch that video. Great video about his insights about buying 181 units as rental properties. And yeah, good to know. Thanks, Cam. Appreciate you. And Rose, most of us lived through it. Yeah, absolutely. I mean, both Jim and I were homeowners back then. CDD, yeah, Community Development District. Thank you very much. There you go. Thanks, Sandra. All right, Jim, any last minute things you want to mention?
Just have a good week, everybody. And thanks again for letting me be on the show. And we'll have some more episodes coming soon to you. And yeah, exciting time for those people that have like short-term rate moving products, because you just saved a little bit of money today, and save it wisely, pay off debt, do something.
I mean, people have credit card balances, they have HELOCs, etc. You're going to see some immediate savings. If you have a ton of money in a interest-bearing account, you'll probably see your rate decrease, unfortunately, though, right? All right. Thank you, everyone, for watching today's video. Please comment below as well. I'll post this video. Once I end this stream, it'll be on my YouTube channel. If you guys have any suggestions for us, you can email us, of course, as well. But please comment and give us any videos you want us to do as well, whether it's myself or with Jim, of course, as well. And also check out Jim's YouTube channel as well. How many subscribers are you up to, buddy?
It's tripled in the last week here, so we got to keep getting more up there. Remember, we get 20,000. I'm going to do something pretty fun, so we'll see. But again, awesome. Thanks for everybody being on, and appreciate your support, Jason.
Yeah, absolutely. Everyone have an amazing day. Please like and subscribe and have an awesome day. We'll see you in the next video. Thanks, guys.